Hello and welcome back to Bunnex Investment Group. So in this video, we are going to be talking about liquidity. Liquidity is something that needs to be understood by each and every trader. And before we go any further, we need to define what it is. So basically, liquidity are points or zones within the markets that consist of a large concentration of stop loss orders or even take profit orders. So these zones are where the market makers are interested in before moving the market in any direction of their choice. Of course, there are external authorities that governs how the market is moved and how many pips should be made per day, which will result into the average daily range. But they are most likely interested in liquidity zones or the points where stop losses are concentrated. So whenever we see the charts as retail traders, usually we see or we look for zones of supply and zones of demand. That is obvious, and that is what they actually want us to see. So in doing so, they can perform what we call cyclic trading to build up these supply and demand zones. These are the points that will entice traders or convince traders to take positions within the market. So in this case, this upper band is usually termed the resistance or the supply zone. And this lower band is what is termed as well the support or the demand zone. So usually when the market knocks twice or thrice on the supply zones like this, it knocked the first time and knocked the second time, it's usually an obvious case that retail traders are going to go short within those zones. So going short is actually a process whereby one has been enticed or convinced to take a position, and after being convinced to take that position, they now know that they have your account in their control. So the next is to actually, if they can as well actually entice buyers in this case. So this process of enticing traders up and down is called accumulation. So accumulation is actually the first phase of trading from the institutional traders. They first accumulate. After accumulating, as I've said, they can perform what we call cyclic trading, whereby a bank sells to another bank and another bank sells to another bank after a price point has been reached. So what I'm just trying to say is, at this point, Bank A can actually buy in the market. After buying in the market, Bank B can actually sell at this point and cancels with more orders than the first bank and retain the market at that zone. That is how they fluctuate the demands and supplies of a particular currency. So after they have accumulated enough contracts on the supply zone and the demand zone, the next thing is now to look for liquidity, right? As I've said or defined earlier, liquidity are points or zones where most stop losses are located. So most stop losses will be located just above these supply or demand zones. After accumulating enough contracts, usually the market will actually hit the stops of those who have gone short at this zone. So hitting stops will introduce liquidity within the market. In layman's terms, we can say hitting stops will actually put money within the market, which now can allow contracts of large institutions to be filled. So filling of a contract is basically a term that refers to when someone buys, there is a corresponding seller. So if you are hit your stops whilst you were in a short, you are being bought out, right? So with that way, they will actually, it's actually a process whereby they are selling to you and you are buying from them at a waste price, right? So in that case, after those stop losses have been hit, you'd see the market actually making a long sustained run, right? Because there is now money within the market like this. So this long sustained run is also there to actually take out those that have been convinced to take buys at these demand zones, right? So I've defined what liquidity is and how these market makers actually manipulate in order for them to actually make a profit from trading. So the next thing is what or how does all this help you in your trading? So it helps you in your trading by knowing that supply and demand zones are points of accumulation within the markets. If you would like to have a higher probability of trading, of winning within the market, you will now need to wait after the market gives you what we call a liquidity grab, right? A liquidity grab, as I've defined it, is actually when the markets are pushed above the supply or demand zones to take out the large concentration of sales, stop loss orders, or even take profit orders. So let's now go over the charts to actually see it how it works in real markets. Are you struggling to make profits consistently in forex trading? If yes, try out our Portal FX indicator that shows you when to buy and when to sell and sends these signals directly to your phone. This indicator does not repaint and bases on the institutional M15 cycle. Simplify your trading by getting your copy for only $100 today, powered by Bunnex Investment Group. So the first thing that I'm going to show you is how to determine trend, right? Or how most retail traders determine trend. This is an H4 time frame on pound USD, and the first thing that we can see is actually we had this as the highest point. So in any trading style or any trading formula, the first thing is always to start on the higher time frame so that you'll be able to see the market trend by actually locating the market structure, right? After seeing the market structure, that is when you can start to look for entry opportunities. That is if you are trading solely on price action, right? In this case, this is the highest point that we were issued in this particular period in time. After that, we can see the market actually going down, and the first thing is actually to get what we call proof of trend. Proof of trend is whereby we actually see a lower high or a higher high. In this case, a lower high was actually issued, a lower high from this point. This was a lower high, right? After seeing this lower high, we now knew that the market is now in a downward trend. That is a high. H4 is somehow a time frame for swing traders, and we now need to go on the H4 time frame, since on the H1 time frame. Sorry, if since we have actually determined the trend that we are now in a downward trend, we now need to go on the lower time frame. In this case, I'm now going to the H1 time frame. Let me put a horizontal line so that we won't get lost when we go to the H1 time frame. So this is the H1 time frame, right? This was the first high, that the first lower high that was issued and gave us a proof of trend, right? So we can see that from that proof of trend, we now know, or we know that most retail traders will be flogged at what we call the supply and demand zones. So in this case, we can see that this point was a point of support or a demand zone. In this era, then we had it now as a supply zone after it was broken by the price market. After that, we saw the first retest, which is this one. And usually retail traders are interested to see a supply or a demand zones being knocked at least twice. That is what is available in many contexts of trading. So we had the first knock, the second knock, right? This is where most retail traders actually entered the market. And after that, this move was actually meant to induce traders to take positions in the short side, right? They sold the market, and later you can see that the market makers had to pull up to grab what we call liquidity, right? So this is where the liquidity was in this case. So what happened? The liquidity was actually grabbed, right? They also, from there, after grabbing the liquidity, you can see that this price was never broken in the future, right? And the market actually dropped to this zone, right? So How do you take advantage, or how do you dodge the hitting of stops at these supply and demand zones? There is one trick that I'm going to review in this video, and I will review more in the upcoming videos. The first trick is you need to wait for price to grab the liquidity. So always trade candlestick reversal patterns above the supply or demand zones. Never be enticed whenever the market is below these zones. So someone may actually say that I'll be left out within several trading points, or I won't find these particular trades. You have a lot of pairs. We need quality in trading. We don't just take chaff. We wait for the proper timings, right? So these are the points where you will be looking to get your entries. Whenever the market goes above the supply zones and give a candlestick reversal pattern, that is when you actually enter. It's actually an assurance that the market is no longer going to come back above those zones. So that is how liquidity works, and that is what liquidity is. This is a very simple version. I've seen several contexts that tries to explain liquidity, but in the end you won't be able to actually utilize or apply it in the practical markets. So this is how you apply it in the practical markets. At supply zones, try to wait for liquidity grab. At demand zones, try to wait for liquidity grab. After liquidity grab has been issued, you would see that you have a higher accuracy rate. So how you attain the supply and demand zones, how I have shown you, is actually one way. There are several ways to find points of supply and points of demand, but whenever you reach those points, try to wait for the market makers to give you a liquidity grab, and then enter at a candlestick reversal pattern above or below the liquidity grab. On that note, we come to the end of this video. Thank you for watching. Like and subscribe.